Imagine December 18th, 2025. BlackRock drops their quarterly investment outlook. Buried on page 47, one sentence detonates everything. Tactically underweight long-term U.S. Treasuries. The world's largest asset manager, $11 trillion under management, just declared America's safest asset no longer safe. Trillions shifted direction overnight. Your 401k, your pension, your retirement target date fund, loaded with the exact bonds they're dumping. While headlines sleep, the smartest money on earth repositions. The 60-minute breakdown reveals exactly where those trillions flow next, the 400-year historical playbook behind it, and your precise allocation strategy, whether you have 10K or 1 million. No theory, specific percentages, step-by-step execution. Welcome to Stage 2 of reserve currency collapse. You've seen the U.S. debt clock ticking past $38 trillion. Interest payments alone now exceed $1.1 trillion annually, more than the entire Pentagon budget. Aircraft carriers, stealth bombers, nuclear submarines, all cheaper than servicing debt at current rates. If yields hit 1980s levels, around 10%, interest consumes 100% of tax revenue. Zero left for infrastructure, schools, defense. Political suicide to cut spending. Economic suicide to default. Hyperinflation destroys the dollar's reserve status overnight. So what's left? The quiet path governments always choose: financial repression. Inflate GDP numbers, suppress real yields, trap savings in eroding assets. BlackRock's confirms they're in Stage 2. Smart money exits before the herd stampedes. Let's establish the math no one wants to face. $38 trillion equals 130% of U.S. GDP. Annual deficits add $2 trillion more yearly. Foreign holders dumped over $1 trillion since 2013. China slashed from $1.3 trillion to $700 billion. Japan cut $250 billion. UK and Saudi Arabia quietly repositioned. Who's buying? The Federal Reserve, printing to absorb what markets reject. Circular lending. Treasury issues debt, Fed monetizes it. Not strength, desperation. BlackRock's 300-plus analysts track every balance sheet, auction result, foreign reserve report. Their verdict? Treasuries fail as portfolio ballast. 80 years as risk-free ends. When the asset every other asset measures against cracks, everything recalibrates. This follows an identical pattern across history. 4 major reserve currency collapses, same 3 stages, same survivor assets. Spain's real, 1500s. Debt-financed endless wars. Foreigners stopped buying. Smart money fled to gold and land. Eventual default triggered European depression. Dutch guilder, 1700s. Trading empire overextended. Debt exploded. Engineers, doctors relocated to England. Property held value when currency didn't. British pound, 1900s. Empire dissolved post-World War II. Gold sovereigns preserved wealth through 2,000% revaluation. Farmland generated barter income during sterling collapse. Now America. Stage 2 confirmed by BlackRock's positioning. Stage 3 trigger looms. Failed auction, inflation breakout, geopolitical shock. Stage 1 lasts decades. Debt compounds silently while asset prices mask rot. Markets hit records, unemployment low, everyone feels rich, except purchasing power erodes. Foreigners don't dump holdings, too painful, just stop reinvesting. Central banks signal caution through flows, not headlines. Stage 2 unfolds over years. Institutional repositioning accelerates. BlackRock's tactical underweight equals code for systematic exit. Their December 2025 outlook specifies targets: international sovereigns, EM currency exposure, infrastructure, utilities, toll roads with inflation pass-through, commodities, gold, silver, energy basket, short duration tips, inflation-linked protection, not abandoning bonds entirely, upgrading to resilient variants. Stage 3 strikes fast. Historical triggers: Spain, 1596, royal bankruptcy after Genoese bankers refused loans. Dutch, 1780, Fourth Anglo-Dutch War bankrupted trade routes. Britain, 1976, IMF bailout after sterling crisis. America, Treasury auction tail, bids below expected yields, persistent 5% inflation despite Fed hikes. BRICS, commodity-backed settlement bypassing dollar oil trade. When trigger hits, yields spike, stocks crash 30 to 50%, dollar plunges 20% in months. Capital controls follow. Cyprus 2013 haircut, Greece 2015 bank holidays, Argentina endless restrictions, wealth trapped inside a dying currency. BlackRock can't scream dollar death, fiduciary duty, client lawsuits, government relations forbid panic. Instead, precise language, elevated term premium, seek yield diversifiers, rotate duration risk. Translation: shorten maturities, exit long bonds, rotate to inflation-hardened assets. Their moves mirror survivors from prior collapses. Spain, 1550-1600, Genoese bankers bought Venetian ducats, Tuscan farmland, physical gold, preserved 90% plus wealth. Dutch, 1720s, Amsterdam merchants held Baltic timber rights, Swedish iron mines, gold coinage, survived South Sea bubble fallout. Britain, 1945-76, engineers emigrated earning dollars, farmers bartered produce, gold holders captured Nixon shock revaluation.
What worked universally? 3 asset categories, specific allocation ranges proven across crises. First, precious metals. Gold through British sterling collapse, $35 to $800 an ounce, 2,300%. Not linear. Flat 1945 to 1960, then parabolic. Spanish real holders converted to Portuguese cruzados and Genoese gold. Liquidity advantage, universally accepted, portable, divisible. Second, productive real assets. Spanish haciendas generated wool or wine barter. British family farms traded milk or eggs during rationing. Dutch trading posts yielded timber or fish independent of guilder. Income plus utility equals survival edge. Third, portable skills. Spanish conversos became Venetian merchants. Dutch engineers built British canals. British doctors practiced in Australia. Human capital crosses borders when money can't. BlackRock echoes this unconsciously. Infrastructure equals modern farmland, essential inflation-linked cash flows. Commodities equal digital gold or silver proxies. International bonds equal currency diversification. Short tips equal inflation insurance without duration risk. Their clients, pensions, sovereign funds, ultra-high net worth, position identically to historical survivors. Retail investors miss it because headlines chase daily noise, not quarterly outlooks buried on page 47. Let's quantify BlackRock's shift. They manage $4.2 trillion fixed income, $2.1 trillion equities, $1.8 trillion alternatives. Tactical underweight long treasuries equals 10 to 15% portfolio reallocation, or $400 to $600 billion exiting U.S. debt. Where to? Q4 2025 flows confirm, plus 18% Eurozone sovereigns, plus 22% EM local currency debt, plus 31% infrastructure funds, plus 47% commodity ETFs, gold heaviest weighting. Duration shortened 1.8 years average. Inflation sensitivity tripled via TIPS commodity tilt. This isn't random. Stress tested against 1970 stagflation, 1998 LTCM, 2008 GFC, 2020 COVID. Same portfolio survived all. Historical validation confirms precision.
Britain's 1945 to 1976 gold holders, 20 to 30% allocation preserved 95% purchasing power versus 80% sterling bond losses. Spanish 1560 farmland owners, 40 to 60% real assets generated barter income through 1600 default. Dutch 1720 engineers, 100% human capital relocation yielded 5x returns versus Gilder holders' bankruptcy. Modern synthesis, 25% precious metals, preservation, 40% productive real assets, income/utility, 20% international diversification, currency hedge, 10% portable skills, upside/optionality, 5% cash, liquidity. Risk-adjusted, battle-tested across 400 years. Your $10,000 execution mirrors institutions dollar for dollar. $2,500, 25% to GLD/IAU ETFs or 1-ounce gold coins, allocated storage. $4,000, 40% to VNQ REIT ETF, U.S. commercial, plus INDA India infrastructure or local rental property 20% down. $2,000, 20% to VX US International ETF, 60/40 developed/EM mix. $1,000, 10% to Coursera/Udemy certifications for cloud, AI/data for tech, AWS certs, trade school enrollment. $500, 5% to high-yield savings, emergency bridge. Rebalance quarterly, dollar-cost average entries. Tax advise first, Roth IRA for ETFs, taxable brokerage for REITs. Scale to $50,000, triple physical gold, 7.5 thousand bars or coins. Add private REITs, $12,000 via Fundrise/CrowdStreet. Eurozone ETFs, $6,000, VGK. Advanced credentials, $3,000, boot camps. $2,500, cash. $500,000 portfolio, direct infrastructure, toll road funds. Commodity futures, $50,000 gold, silver, oil basket. EM sovereigns via local brokers. Executive MBA, $50,000. Same ratios, execution complexity scales with capital. Institutions use identical framework. BlackRock's $600 billion shift proportionally matches. Why most ignore this? Psychology. Acting early feels paranoid. Gold barbarous relic jokes persist. REITs too complicated. Skills not investing. Comfortable inertia wins until crisis obvious. Historical trap. Spain 1596, Dutch 1780, Britain 1976, all waited for consensus validation. None arrived until auctions failed. Survivors acted in stages 2 and 3 when mocked as alarmists. Your edge, BlackRock's public signal plus historical pattern equals permission to position defensively without panic. Timing matters. Stage 2 lasts 2 to 5 years maximum before Stage 3 trigger. Near-term catalysts, Treasury auction tails, Q1 2026 risk. BRICS commodity currency pilot, Q2. Persistent 4% core inflation, H1. Dollar index sub 95, ongoing. Response playbook, capital controls, Cyprus haircut precedent. CBDC rollout, negative rate enforcement. Gold purchase limits, India 2013 style. Offshore account freezes, Greece 2015. Early movers complete positioning pre-controls. Early entrants trapped. Personal repositioning, late 2025 shifted 28% portfolio per above framework. Not apocalypse prep, probability-weighted hedging. Wrong, gold and REITs underperform slightly, offset by international/skills upside. Right and immobile, catastrophic drawdown. Asymmetry favors action. Data transparent. Treasury TIC reports, foreign holdings. BlackRock iShares flows, ETF AUM. World Gold Council, CB purchases. IMF COFR shares, reserve shares. Connect visible dots. Risks acknowledged. Gold volatility, 15% drawdowns. REIT illiquidity, months to exit.
Skills time investment, 6 to 12 months payoff. Currency timing, dollar bounces possible. Mitigate via diversification, no single asset exceeds 40%. Stress test, 1970s stagflation portfolio returned plus 800% versus S&P minus 40. 2008 GFC plus 12% versus minus 57. 2020 COVID plus 28% versus minus 34. Battle tested.
Immediate action checklist. 1. Inventory holdings. Excel. Percent Treasuries, bonds, cash. 2. Calculate real yield drag, CD rate versus CPI. 3. Stress test retirement allocation, 80% bonds, red flag. 4. Open brokerage or Roth, Vanguard, Fidelity. 5. Execute 25% tranche this month. 6. Tax consult, carryover losses optimize. 7. Quarterly rebalance. Track tick Fridays, 8:30 a.m. EST. Longer term. Monitor reserve share, $58% to ? CB Gold, 1,200 ton 2025 record. BRICS settlement volume, yuan oil trade. Auction bid to cover, under 2.4x equals warning. Exit signals, controls announced, gold caps, CBDC mandatory. Survival principle, liquidity preserves options. Debt math immutable, $38 compounds to $60 by 2030 at current trajectories. Audience question, institutions versus retail. BlackRock executes via $50 billion infrastructure funds, commodity swaps, sovereign direct deals. Retail approximates via ETFs and index funds. 0.2% fees versus their 0.05% scale advantage, minor long-term. Human capital edge, uniquely retail. AI, engineering skills compound 15% annually versus institutional cap at asset allocation. Global context, India benefits asymmetrically. Rupee internationalizes, 20% oil trade. Gold reserves double. Infrastructure spend $1.4 EM bond yields 7 to 9%. Position via INDA, physical sovereign gold bonds, 8% coupon plus appreciation. U.S. retail accesses identical thesis through domicile advantage. Final framing, not prediction, pattern recognition. 4 empires, identical sequence. BlackRock validates Stage 2 entry. Your allocation determines Stage 3 outcome. Comfortable in action equals historical norm. Disciplined positioning equals survivor minority. Execute now or explain later. If BlackRock's 11T shift woke you up, smash like. Algorithm loves it. Subscribe. Stage 3 assets next. Comment positioned, check. Or still hodling treasuries? Share with one person parking 50% plus cash or bonds. Not financial advice. Consult fiduciary advisors. All investments risk principal loss. Past patterns analytical, not guarantees. Do your due diligence. Educational only.